You spend 4 months searching for a business, and 2 weeks before closing, the lender declines the loan. You negotiated the price, hired an attorney, paid an accountant, ordered an appraisal, and signed a purchase agreement. You wrote a check for due diligence, not because something changed, because the numbers never worked in the first place, and nobody caught it before you were this deep. That is not a rare story. It happens to buyers who have good credit, enough for a down payment, and a business they genuinely believe in. The rejection still comes, and by that point, the cost is months of time, thousands of dollars in fees, and a search that starts over from scratch. Most SBA loan rejections fall into 4 predictable categories. They are called the 4-lender test. Understand them before you make an offer, and you can stop chasing deals that were never going to close. Welcome to Main Street Ledger. I'm Kurt Rose, CPA, former CFO of an SBA lender and entrepreneur. We cover small business acquisitions, SBA lending, franchise ownership, and business finance, all drawn from public sources and experience. If this is your first time here, subscribe below. This is education, not financial, legal, or investment advice. Here is where most first-time buyers get the process wrong. They walk into an SBA loan assuming the lender is deciding whether they personally qualify. Good credit, solid down payment, ready to sign. The reality is more layered than that. When an SBA lender underwrites a deal, they are running 4 evaluations at the same time. They are looking at the borrower, they are looking at the business, they are looking at whether the transaction structure makes financial sense, and they are looking at whether any of it can actually be proven with documentation. Most loan denials are not caused by one obvious red flag. They are caused by several smaller concerns that accumulate until the lender no longer has enough confidence to approve the deal. A buyer with strong credit can still get denied. A profitable business can still fail underwriting. A reasonable price can still produce a transaction that does not work on paper. The 4-lender tests explain exactly where that happens. Test 1, the borrower test. Test 2, the business test. Test 3, the deal test. Test 4, the documentation test. The first test is the borrower test. The question the lender is working through: is this borrower someone we can approve? Lenders evaluate the borrower and the business at the same time, but what they need from you personally covers a lot of ground. Credit history, personal financial position, relevant experience, and how much liquidity you will have left after the down payment clears. That last one surprises a lot of buyers. You can have enough money to close and still give a lender pause if closing leaves you with very little in reserve. There is another layer beginners often do not think about. SBA lending involves certain eligibility and compliance checks that are part of the standard process. Things like whether there are outstanding federal tax obligations, prior issues with government-backed loan programs, or other flags a lender is expected to review. These are not automatic disqualifiers in every case, and how much weight they carry depends on the full picture. But if something in your background could come up during that review, the better move is to surface it with your lender early. A disclosed issue the lender can assess in context is a very different situation than one that surfaces mid-underwriting as a surprise. The borrower test is not a single score. It is a lender forming a judgment about your complete picture. Know what that picture looks like before you apply. The second test is the business test. The question: can this business actually support a loan? This is where buyers get a surprise they were not expecting, and it is the one that catches the most people off guard. The seller hands over a summary showing strong earnings, and the buyer takes it at face value. The lender does not. The lender looks at what the financial statements actually support after working through the numbers. Removing personal expenses run through the business, taking out one-time revenue items that will not repeat, and setting aside add-backs the seller cannot document with hard records. That process almost always produces a lower number than what the seller claimed. A business the seller says earns $260,000 might come out closer to $190,000 after that review, and the lender is underwriting the adjusted number, not the seller's figure. That gap between what the seller claims and what the financials actually support is one of the most common reasons SBA deals fail, and it is almost always a number the buyer never asked for before signing. The practical move is to get to that adjusted number yourself before the lender does. Request the tax returns. Look at multiple years. Try to understand what the financials show when the add-backs are stripped out. If the business cannot support the debt at the real number, you want to know that before you are 4 months in and already spending money on attorneys and appraisals. The third test is the deal test. The question, does this transaction actually make financial sense? A good borrower and a good business do not automatically produce a good deal. The structure of the transaction matters just as much. Purchase price, total debt load, working capital needs, and how all of that stacks against the cash flow the business actually produces. A business does not generate more revenue because a buyer paid a premium for it. If the price is elevated because multiple buyers competed and bid it up, the lender still has to determine whether the adjusted cash flow can carry the payments. That judgment involves more than arithmetic. A lender weighing a deal like this is looking at the overall risk picture, and a strong borrower does not automatically offset a price that the cash flow cannot support. Buyers also often miss this. Lenders are not just looking at the loan in front of them, they are looking at your total financial obligations, existing personal debt, and other commitments that already have a claim on your cash flow. Obligations that look manageable on their own can shift the picture when the new loan payment is added on top. Before you sign a purchase agreement, do a rough version of this math yourself. At this price, with this structure, does the adjusted cash flow leave enough room to cover the payments with something left over? Answer that before you commit. The fourth and final test is the documentation test. The question, can any of this actually be proven? This one catches people off guard because by the time buyers reach underwriting, they have already mentally cleared the other three tests. Missing tax returns, bank statements that do not match the profit and loss, deposits that cannot be explained, financials that tell a different story from one year to the next, a seller who is slow to return document requests. Any of these creates uncertainty, and lenders do not approve uncertainty. They decline it. SBA lenders rely heavily on documented financial records, and that reliance has grown in recent years. The seller's story has to match the records. The records have to be complete. Gaps that seem like administrative details to a buyer can become actual obstacles to approval. Push for complete documentation early, before the purchase agreement is signed if possible. If the seller cannot produce clean, consistent records on a reasonable timeline, that is important information to have before you are deep into a process that depends on them. Now let me show you what all four tests look like in a single deal. A buyer found an HVAC business priced at $850,000. The seller claimed earnings of around $260,000. The buyer put 10% down, signed the purchase agreement, and started the loan process. On paper, it looked workable. Underwriting told a different story. After removing add-backs the seller could not document, the lender found the supportable cash flow was closer to $195,000. The business had also lost two major commercial accounts in the past year. After the down payment, the buyer had about $8,000 left in savings, and the price was elevated because multiple buyers had competed for the deal. None of those issues alone kills the loan. Together they do. Thin reserves, a normalized earnings number well below what the seller claimed, and a price that left almost no margin for a slow first year. The lender saw a transaction where too many risks pointed in the same direction. By the time the loan was declined, the buyer had spent roughly $15,000 on fees and due diligence. The search started over. That outcome was not inevitable. It was the result of not running these four tests before signing. Here is what to take with you. Lenders run four evaluations at the same time: the borrower, the business, the deal structure, and the documentation. Your credit score is one input into one of those four. The seller's claimed earnings and the number a lender can actually underwrite are frequently different. That gap is one of the most common reasons deals fail, and most buyers never ask for the adjusted number before they sign. A strong borrower can still get denied if the purchase price outpaces what the business can support. Lenders are assessing the overall risk of the transaction, not just whether the borrower qualifies on paper. If there are any issues in your background that a lender would be expected to review, surface them early. A disclosed issue is easier to work through than one discovered mid-underwriting, and most SBA loan rejections are not caused by one fatal flaw. They happen when several smaller concerns accumulate until the lender loses confidence in the transaction as a whole. Before you fall in love with a business, ask whether a lender would see it the same way you do. If you want to go deeper on how SBA deals are actually structured, the previous video walks through the mechanics of a 7A loan from the ground up. Link is in the description. And if this gave you something useful, subscribe. There is more coming. Research the deal before you fund the deal.